Welcome back. This is Chart Overload. I am Ryan Mumy, the CEO of Sollinda Capital Management, and with me is who I claim to be my best friend, but also my business partner. He doesn't likewise claim that with me. Justin Greenhill, our Chief Investment Officer. Justin, always a pleasure to get together with you.
He claims. Good day.
Yeah, he claims. It's a holiday weekend. I'm dressed comfortable, working from the casa, and we're going to talk about some charts, a lot of charts. Let's go ahead and get started. First one in big picture, just looking at the U.S. economy, and contrary to what were many beliefs coming into this year, the U.S. economy has expanded at faster clips than many had anticipated and pontificated about.
Yep. So this first graphic shows that last quarter GDP disappointed a bit, but this most recent quarter it's popped right back up and surprised to the upside. So left chart GDP, right chart business investment, which as you can see has been a pretty big driver the last two quarters.
Yeah, that's been good. And this next chart looks specifically at looking at information processing equipment plus software, that AI stuff. We've talked about this before, but this is a great visual of the amount of money being spent, CapEx on that.
Yeah, so just to kind of think about it this way, this is data centers, this is buying chips, this is buying basically everything the big firms are doing to invest in the AI situation. And the bottom line here, as it creeps up, that is basically, as of last quarter, contributing more to GDP than domestic consumption, which is a pretty remarkable thing in and of itself.
Yeah, and moving along, and that was a first, right? This chart shows first time that has, outpaced all consumer spending, which it just shows that's why money's been chasing that particular segment of the market, as they're following that investment. Moving along, this chart, I don't know where you got that, but I kind of like the aesthetics of it. But this just shows talking about retail investors and foreign investors, and how much and the volume and when they're pumping money into the equity markets.
So yeah, first chart here, this basically shows S&P 500 going back some time, and the blue line is basically 12-month net inflows of foreigners into U.S. stocks. And, I guess you would say interestingly, or non-insignificantly, it seems that foreign money oftentimes does really tend to pile in at the top of the cycle. So to be determined if that's the case this time.
An interesting anecdote. You see me wearing my Blue Jays hat. I was in Toronto, unbelievable city, unbelievable stadium. As a baseball guy, I'd never been there. The Rogers Center's great. Anyways, just talking to some Canadians, they're not the ones buying U.S. assets. They're pretty anti-traveling to the U.S., as we've seen from data, but also putting money here. I was talking to one guy who said he has parents on a travel hockey team that refuse to send their kids to tournaments in the United States. So anyways, anecdotal evidence of charts that we've seen. And while foreign investors are piling into the markets, it didn't appear from my limited experience that it included our Canadian brothers and sisters. This next chart looks specifically at retail option buying. It was something we saw from Citadel.
Yeah, and basically what this shows is just retail continues to buy. So this has been one of the biggest streaks of retail buying of domestic equities that we've seen in some time. And you combine that with the fact that foreigners are buying, and as we've discussed in recent commentary, the institutions have had to chase the market higher. We then get where we are right around or at all-time highs.
Which in of itself doesn't mean it's going to fall off. But we talked about this earlier in our Friday huddle with all of our advisor partners that, there's things working against the market, but there were things working against the market in May, and you had the seasonality of selling may and go away. And if you've done that, you're regretting it. Moving on to domestic stocks. This first one just looks at a similar theme we've had for better part of several months. This looks at small caps relative to their big brothers in the S&P 500.
Yep. Red orange line is Russell 2000 small caps. Black line S&P 500, which is driven by the mega caps. And as you can see, really since the initial rally out of COVID, small caps have underperformed quite significantly, albeit they've started to potentially catch up of late.
Yeah, they've been on a ripper here the last few weeks, but it's coming in that same level that we've talked about on our recordings numerous times. Next chart, this shows one of the advantages that large cap have over small caps. Looks at some buybacks.
Yeah, which again, this is the big difference, or one of the big differences between mega caps and small caps. And as you can see here, the biggest of big companies are buying a tremendous amount of their own stocks back. So that continues to be a tailwind to those equities.
Yeah, they're sitting on large amounts of cash, or their access to the credit markets is so much greater than small caps. With credit spreads at the tightest levels they've been, they can issue some bonds at low interest rates and pile it back into their stock, assuming they're going to create shareholder value. But that's something small caps, as we've talked about, necessarily can't do. Moving on to the next chart, we're going to look at the VIX a little bit, volatility index. We've covered that oftentimes people call it the fear gauge, and how we like to look at it is there's a lot of speculation in it from the institutional community. And so this looks at how are the speculators, particularly driven by institutional big pots of money, how are they positioned? And they're short. They're short the VIX.
Short the VIX, and pretty massive size. So this doesn't necessarily mean that risk is imminent, but what it does mean that if the market does start to move lower here, there is extra fuel on the fire from positioning here.
Yeah, tailwind, right? Like the rising tide lifts all boats. Same thing, tide going out, all boats go down. And it doesn't necessarily mean a company stinks, but it's going to participate. And we added this next chart. This just shows the S&P 500 over that last time frame when the VIX was this net shorted back in I think the chart's June of 22 to June of 2023. And the red line is the VIX, the green line for the S&P 500. And it just shows that, once that volatility started happening, it kind of exacerbated to the downside on the S&P, and the VIX went up really quickly.
Yeah, many instances of positioning playing a big part there over the years.
Because the last time that happened, there wasn't necessarily a big event. It just, again, kind of snowballed once it started. This next chart looks at NVIDIA. That was the big news this past week, was their earnings, kind of the last big earnings announcement. And, this shows over time their sales growth.
Yeah, which, as you can see here on these black bars, really since coming out of 2022 and into 2023, the I guess rate of change, you could say, in terms of their revenue growth, albeit pretty significant on an absolute basis, has started to slow as the CapEx cycle becomes more mature.
Yeah, we put out an interesting fact in our latest Monday morning commentary that what was it, 40% of their revenue comes from just a few companies, and it was Microsoft and I think Amazon was one and Meta was another. But that I didn't know that. It was a eye-popping fact. Was that it?
Yeah, and to that point, we mentioned earlier on the top here about CapEx spending for AI and data centers was so significant. A big portion of that is these companies buying chips from NVIDIA.
Moving on to non U.S. stocks. This first one looks at Asia ex Japan, and it's been pretty strong.
Yeah, been a good year so far, year to date for international, and this has been no different. So despite tariffs and despite all the risk that's going on geopolitically, Asia ex Japan continues to perform well.
Next one, again, similar chart, just looking at Latin America performance.
Yeah, so even better in terms of what's happened here year to date. But as one can see, it's just now basically starting to kind of break out from highs after having a pretty tough last few years, but in particular, a really rough year last year.
And a big component of Latin America, this next chart looks at Brazil and their president's support or approval rating, Lula.
Yeah, so by far the biggest economy and the biggest stock market in Latin America. There's been the issue with Trump putting tariffs onto the country, and there's been sort of a back and forth. But the look ahead is very much focused on next year's election, and it is believed by the market, at least, that if the incumbent were to lose, that would be positive, and vice versa. So what we've seen here recently is it's starting to go in the favor of what would be a challenger to the leftist government.
Yeah, who's more what we would call right-leaning, more business, pro-business, etc. Similar policies. And there's also two other pretty big presidential elections next year in Latin America. Chile and Colombia, yep. I believe. Yeah. Yep. So that bears watching. Moving on, this looks at the rupee, Indian economy, and what's going on there.
So that's a tariff story also. There's been direct tariffs, and then there's also been indirect tariffs by the Trump administration for the Indians buying Russian oil. So what this basically shows is the black line is the rupee has been on a pretty significant depreciation versus the dollar of late, based largely on concerns that tariffs are going to negatively impact the economy there.
Yeah, to be, again, things to watch, as that is an exceptionally large economy. Moving on to our next section, let's look at interest rates, at bonds and fixed income. This first chart just takes a look at the 2-year yield and the 10-year yield, going back a couple of years, year and a half.
Yep, so black line, 10-year yield, yellowish orange line, 2-year yield, and you've seen a divergence. So think of that as the Fed is cutting and signaling more interest rate cuts, which is bringing down shorter duration interest rates. But the black line, yields are hanging in there, and the logical narrative behind that is there's still inflation risk, there is deficit risk, etc. And at least for now, that's holding the long end of the yield curve rates up higher than the short end.
Yeah, big common misconception is that the Federal Reserve controls all interest rate levels, and that's just not true. The short term, the 2-year and shorter, oftentimes goes in the same direction of what the Fed does. 10-year, 30-year often or most times are driven by market participants' anticipated levels of inflation and growth. So the Fed can cut rates, and that doesn't mean the 10-year is going to drop. Like we've seen here, markets participants have been anticipating more drops from the Fed, and the 2-year has followed course, but the 10-year hasn't. And I say that going to our next chart, it shows that sometimes that does happen, where the Fed cutting rates can, over history, the 10-year has come down after that's happened.
Yeah, it just shows, at least historically speaking, this chart is that, although it may lag like we're seeing right now, at least historically, longer duration interest rates have ended up following shorter duration interest rates lower. So if that ends up being the case now, then, longer duration government debt does look attractive, at least on a yield basis. But there's also plenty of reasons to believe that, this time could be different.
Yeah, to be determined. We keep watching the fixed income market because, as we've talked about, it's substantially larger than the stock market, and oftentimes can drive price action in stocks. This next chart looks at the U.S. 5-year inflation swap. Why don't you give us a little elementary education on what that is, Justin?
Yeah, so this is just one of a few different indicators that would, potentially explain why longer duration interest rates are sticky at higher levels relative to shorter ones, and it's just because the market, that's what this is in this inflation swap, the market is pricing in inflation going forward 5 years out that is higher than what we saw uh, pre-pandemic.
Yeah, so as such, the forward expectations are higher, so yields on the longer end could be higher. And then finally, in fixed income, let's take a look at corporate bonds relative to the leading economic indicator index.
Yeah, and what's interesting about this is if you look at the blue line on the top that started to roll over, that's basically a one of the sentiment gauges of the economy. And typically, when that rolls over, you'll see credit spreads, which is the white line, starting to widen. We've yet to see that happen. And one possible explanation has just been that there are so many flows for portfolio instruments, of which fixed income is a big part of it, and corporate credit, high grade corporate credit, is a major part of that. It's possible that, unlike times past, those flows are actually starting to distort markets as opposed to markets just moving based on traditional fundamental indicators.
Yeah, that to be determined. The spread, that white line, the difference that investors are demanding to buy corporate bonds relative to U.S. Treasury bonds. It's the tightest it's been since 2008, 2009, and to Justin's point, the leading economic indicator index has rolled over, but spreads haven't tightened, meaning investors aren't demanding more interest to justify the increased risk. And again, it's just something we're watching. Is this time different, or is it on a lag? Or to Justin's point, is it distorted? And there's something else that will drive a traditional relationship for these lines to come together. We don't know, but it bears watching. And final section, let's talk about commodities. This first chart looks at oil.
Yeah, and oil's been, I guess, interesting, but interesting because it hasn't really done much for some time. It's basically continued to kind of consolidate for a few years now, and most recently start to move back lower. And a big reason for that is there's obviously been geopolitical risk, which is, normally a positive for oil. And then at the same time, there's been a pretty resilient economy, which is normally positive for oil, but there's been a tremendous amount of supply that's not only continuing to come online in the global oil market, but more that is potentially planning to come on in the year ahead. And we mentioned Brazil earlier in the international section, but they are a big contributor of increasing their global output.
Yeah, I mean, and supply and demand will, for the most part, oftentimes drive oil because it is so large of a market. Final chart. Let's talk about gold. I'm always reminded of that Austin Powers movie when we talk about gold. But anyways, gold has been trading sideways as we see here for some time, and could it be perking its head up?
Yep, big move higher over the last couple years, and for several months now, it's been sort of kind of moving sideways up near all-time highs. But as of this most recent week, it looks like it's starting to perk up again. So we shall see, but definitely still in a bull market.
Yeah, and from a technical standpoint, the FinTwit folks are talking about that it's coiling, and that's just where all these moving average lines are coming together and creating a spot where it has to move in one direction, up or down. But to our point this week, if gun to head somebody said which way is it going, it's showing some momentum, some strength to the upside. So it bears watching as that spills over into all kinds of other asset markets. But really appreciate you joining us today. I hope you got something out of it. We know you could spend your time a lot of different places. We appreciate you spending it with a couple guys passionate about the markets, trying to educate. We are Sollinda Capital Management. If you're interested in anything we talked about, you want to dig a little deeper, email us at info@sollinda.com, info@sollinda.com. I think they put it on your picture now, but Thank God that's not up to us. But again, I'm Ryan. That's Justin, and we will be back next time. We hope you have a great week.
Have a good one.